If you've priced a weekend in Las Vegas lately, you already know something is broken. A standard room at MGM Grand in October is $285 before fees. A vodka soda at the casino bar, $24. A steak at a mid-tier restaurant, $68. These aren't luxury splurges, they're the new baseline. The official explanation is inflation. However, the real driver is structural. Caesars Entertainment and MGM Resorts do not own the land under their flagship casinos. They sold it years ago, now lease it back at escalating rates, and are buried under $26 billion in combined debt. That fixed cost is pushing every price you pay higher and visitor counts lower. The Las Vegas Convention and Visitors Authority released September figures on October 29th. 3.1 million visitors, down 329,000 year over year, a 9.6% drop. Year to date through September, 29 million, 8% below 2024. Strip hotel occupancy, 78.7%, which is the lowest September since 2011, if you exclude 2020. Room rates remain elevated but are now declining month over month. The average daily rate on the Strip for July 2025 was $164. September, $152, down 7%. Gaming revenue on the Strip, $688 million in September, down 5.5%. Room revenues specifically down 11%. Air passenger volume at Harry Reid International, 4.1 million in September, down 6%. Year to date, 2 million fewer passengers than 2024. These are not seasonal blips. They are the first sustained decline in mass market demand since the pandemic. The core issue is real estate ownership. Between 2017 and 2021, MGM and Caesars executed sale-leaseback transactions with VICI Properties, a real estate investment trust spun out of Caesars' 2017 bankruptcy. MGM sold 11 strip and regional properties, Bellagio, MGM Grand, Aria, Mandalay Bay, and others to VICI in 2019 to 2020. Caesars sold Caesars Palace, Flamingo, Harrah's, and others to VICI post-El Dorado merger. Total land and buildings now controlled by VICI include more than 800 acres of some of the most valuable land on Earth.
It's about 5 years ago, MGM split its one company into two, I should say. MGM Resorts, which operates about a half a dozen resort casinos on the Strip, and then MGM Growth Properties, which owns the real estate. We're talking the physical buildings and the land that houses those resorts. Well, today, MGM sold its Growth Properties to VICI in a deal worth more than $17 billion. And as part of that deal, MGM Resorts will receive about $4.4 billion in cash, and it also allows the company to sell off its real estate assets on the Strip so that it can become a bigger player in online gaming and overseas.
It doesn't stop at Caesars and MGM. VICI also acquired the Venetian, Palazzo, and former Sands Expo and Convention Center from Las Vegas Sands Corp. for $4 billion in cash in 2022. In late 2022, VICI announced it was providing $350 million to finance the completion of the Fontainebleau. And just this last week, VICI announced that it is buying the Strat and 6 other casino properties from Golden Entertainment for $1.16 billion and leasing them back to Golden founder Blake Sartini.
One of the company's executives says with this deal, VICI is now the largest private owner of meeting and convention space in the country and the largest hotel owner in terms of U.S. hotel rooms.
The leases are triple net. Operators pay base rent, plus property taxes, plus insurance, plus all maintenance. And the initial terms were 15 to 30 years. Annual escalators of 2% or CPI, whichever is higher. An example of this is MGM's 2024 10K showing $1.1 billion in annual lease expenses to VICI alone. Caesars paid $925 million in rent in 2024. These are fixed obligations that must be paid whether the casinos are full or half empty. Add in the leases to the balance sheet debt. Total combined debt for the two operators is $57 billion when leases are capitalized at a 6% rate. Interest plus rent now consume more than 50% of operating cash flow before any reinvestment. Here's how the math forces price increases. Fixed lease and interest costs rise every year. To maintain cash flow coverage, revenue per visitor must increase. The only levers are higher room rates, higher food and beverage prices, and new fees. Because of this, the demand to visit Las Vegas falls. With fewer visitors, per-person revenue must rise further to hit the same dollar total. It's a classic fixed cost death spiral. The result of this is the marginal tourist, families, convention side trippers, bachelor parties, all booking elsewhere. Cruise lines, Mexico, and domestic beach destinations are reporting record Vegas defections. The companies are now acknowledging the problem publicly. MGM CEO Bill Hornbuckle, in his Q3 call on October 30th, said, "We got ahead of ourselves on pricing. Shame on us. We're adjusting rates downward, particularly in the value and mid-week segments." Caesars CEO Tom said, "High room rates clearly impacted demand. We expect a softer summer 2026 and are recalibrating."
The CEO of MGM Resorts now admits high prices were a mistake through the summer and contributed to a negative perception of Las Vegas.
When we think about pricing and things that got everyone's attention, whether it was the infamous bottle of water or a Starbucks coffee at Excalibur that cost $12, shame on us. We should have been more sensitive to the overall experience at a place like Excalibur to those customers. You can't have a $29 room and a $12 coffee.
They understand that they pushed too far and are now in damage control mode. There are 3 theoretical exits to this scenario, and none of them are easy. First is to renegotiate the leases, but VICI has zero incentive to do this. Triple net cash flow is their entire business model. Second is to refinance debt at lower rates. The savings here, however, would be marginal. Third is to aggressively cut prices to regain volume, but this requires accepting years of negative cash flow while debt keeps compounding. Bankruptcy is off the table. It would crater consumer confidence and kill convention bookings. So that leaves them with only one option. The only realistic path is price deflation, at least until occupancy stabilizes, then a slow recovery. That process could take 18 to 24 months and requires both companies to coordinate. So what are some practical takeaways from all of this so that you don't get screwed on your Vegas trip? Book mid-week, 45 to 60 days out. Dynamic pricing drops 40 to 60% on Tuesdays through Thursdays. Stay off-strip or downtown. Fremont Street occupancy is 85% at half the room rate. Avoid event weekends. F1, March Madness, EDC, all rates inflate 3 times. Earn tier status. MGM Rewards and Caesars Rewards still waive resort fees at Pearl and Gold level. I believe Vegas will survive, it always does. But the mass market model built on $59 rooms and $1.99 shrimp cocktail is gone until the cost structure is reset. Do you think Vegas can recover from this? Or are the casinos too greedy to realize they need to drastically lower prices? Leave your comment below. Thanks for watching. Subscribe for more breakdowns like this, and I'll see you next time.